There's a reason why many investors do not achieve sustainable returns. The fee of 1% that you believe to be the only expense of investing in a mutual fund is just one of many possible fees. In fact, a mutual fund can eat over 60% of your potential profit over time. And this is just the beginning, as we will discover how mutual funds often advertise returns that are not the actual returns investors receive. Imagine someone offers you the following investment opportunity. He's proposing a deal where you would have to put up 100% of the investment capital and have to face all associated risks, while he would be entitled to 60% or more of any profit made through fees. Additionally, in the event of a loss, you would suffer the consequences while he would still receive payment. Would you be interested? Of course not. This is an outrageous proposition. However, if you are like most American investors, you have already agreed to these terms by investing in a standard mutual fund. You put up 100% of the capital, you took 100% of the risk, and you got 33% of the return. Before we look at what other inequities are hiding in the market that you should be aware of, how to get around them, and which investments offer much more attractive terms, let's first find out why so many people invest in funds with such terms. Let me explain this with the words of Jack Bogle, founder and chief executive of the Vanguard Group. A firm will go out and start 5 incubation funds, and they will try and shoot the lights out with all 5 of them. And of course they don't with 4 of them, but they do with 1. So they drop the other 4 and take the one that did very well, public with a great track record, and sell that track record. Feel free to use that to look brilliant at your next cocktail party. Imagine if you could do the same with your investments. You pick, say, 5 stocks. Then, when 4 of them make a loss, you just forget about them as if they never existed. And then you can tell your friends that you are the best investor since Warren Buffett. And by the way, I wouldn't mind if you showed the like button who's the boss. Before we continue, I want to mention that the topic we are discussing and the numbers we will see are not based on my own opinion or funny math. They are based on studies, research, and the book Money Master the Game by Tony Robbins. I am just tying up loose ends and want to give an objective view of the subject. If you want to read the book yourself, check out the video description. The underwhelming performance of highly rated mutual funds has been extensively examined in a Wall Street Journal article. It describes a study conducted by researchers who analyzed the 10-year performance of investors who purchased 5-star funds. Of the 248 mutual stock funds with 5-star ratings at the start of the period, just 4 still kept that rank after 10 years. The probability of a shooting star not transforming into a supernova is only 2%. Tony Robbins interviewed Jack Bogle for his book on how Wall Street manages to get so many people to invest in mutual funds. His answer? Marketing. People often overlook the impact of fees on their investment returns. Robbins' first money principle is, don't get in the game unless you know the rules. You have to learn the rules of the game, and then you have to play better than anyone else. Let's do some quick math. If we assume an annual return of 8% and invest $10,000, the future value after 50 years is $469,016. Assuming a 2.5% annual fee for the fund manager, that would be $145,420, almost 70% less. Now you may say that mutual fund costs aren't that high, but we'll get to the fact that in most cases they are even higher because of hidden fees in the fine print. It's true that the numbers look small at first glance, but when you calculate the impact of excessive costs multiplied over many years, it takes your breath away. We are always busy, and when people don't have enough time to manage their money and investments, it's basically a coin flip. So it's completely natural to turn to a fund manager in the hope that his stock picking skills will pay off. The only problem is, over any sustained period of time, a whopping 96% of actively managed mutual funds do not outperform the market. Robert Arnott, founder of Research Affiliates, a well-known industry expert, conducted a study over 2 decades on the top 200 actively managed mutual funds with at least $100 million under management. The results of the study are surprising. Only 8 out of 200 fund managers outperformed the Vanguard 500 index over a period of 15 years. This means the chances of picking a winning actively managed mutual fund are less than 4%, which is lower than the odds of winning in blackjack when you have a hand of 2 face cards, each worth 10, and take another one. Your odds of winning this would be more than twice as high. And even if a fund manager successfully beats the market, this is no guarantee that he will continue to do so, and that it's not just a matter of luck. Jack Bogle explains this with the following words. If you pack 1,024 gorillas into a gymnasium and teach them each to flip a coin, one of them will flip heads 10 times in a row, Most would call that luck, but when that happens in the fund business, we call him a genius. And what do you think the odds are that this gorilla can do it again? To clarify, the term beat the market refers to outperforming a stock index. For those who don't know, an index is a basket of stocks like the S&P 500, which contains the 500 largest US companies by market capitalization. The performance of the index is based on all the stocks on the list collectively. You can achieve diversification by investing in a low-cost index fund that replicates the index. This means you can reduce your risk, increase your returns, and save fees you would pay to a fund manager. According to the renowned market research company Dalio, which conducted a study over a 20-year period, the S&P 500 achieved an average annual return of 9.28%, while the average investor invested in mutual funds earned only slightly more than 2.54%. We know that the objective of investing is to achieve the highest return with the least amount of risk and cost. During the 2008 to 2009 market downturn, fund managers had ample time to take defensive actions, but even then, they failed to outperform the S&P Growth and S&P Small Cap indices. According to the SPIVA scorecard, which benchmarks actively managed funds against their index, the S&P 500 Growth Index outperformed 90% of large-cap growth mutual funds, while the S&P 500 Small Cap 600 Growth Index outperformed 96% of small-cap growth managers. Here is the data for the last 15 years. I'm not saying it can't be done, but consistently beating the market over a period of 20 or 30 years is a rare feat achieved by only a small group of fund managers. These unicorns are rare. However, the doors to these funds are closed to new investors, and even when they were open, the minimum investment required is typically in the millions of dollars. Hedge funds that become too large face difficulties in buying and selling investments quickly and easily, resulting in lower returns. According to Zero Hedge, a financial news site, the majority of hedge fund managers fail to outperform the S&P 500. In 2012, the average fund returned only 8%, while the index returned 16%. In 2013, hedge funds returned an average of 7% compared to the S&P 500's 30% gain. In other words, the average hedge fund investor missed out on over 30% profit in a 2-year period. On top of that, hedge funds often charge fees of 2%, take a 20% cut of all profits, and any gains received are subject to high ordinary income tax rates. That hurts. Most people asked are unaware of the exact amount they pay in fees. The financial institutions responsible for collecting the fees have become adept at either concealing them or making them seem insignificant. To achieve financial independence, it's crucial to maintain consistent progress, and excessive fees can set you back by eroding your account balance. Therefore, the fundamental question is whether you're contributing to your retirement or somebody else's. The Forbes article titled, "The Real Cost of Owning a Mutual Fund," reveals the actual cost of being invested in a mutual fund. On average, the cost of owning a mutual fund is a hefty 3.17% annually, which is really high compared to owning the entire market by investing in an index fund like the S&P 500 for less than 0.1%. While it may be justifiable to pay fees to exceptional hedge fund managers like Dalio, who outperformed the market over a 30-year period, the majority of mutual funds charge fees that are almost 30 times higher, or 3,000%, than those of index funds. Can you imagine paying 30 times the amount your neighbor paid for the same car, but it only goes 30 miles per hour? It's like putting all your eggs in one basket and adding a grenade at the end. When you pay high fees, you give up an absurdly large amount of future earnings. This drags you back down the mountain and can cost you decades of patience and hard work. Let's look at the real world. From January 1st, 2000 to December 31st, 2012, the S&P 500 didn't yield any returns, making it a flat period. This time is widely known as the lost decade because investors didn't see any progress despite facing significant market volatility, including the market surge until 2007, the market crash in 2008, and the bull market that started in 2009. Assuming you had invested your savings of $100,000 over this period in an index fund that tracked the market, your account would have remained the same and you would have paid little to no fees. However, if you had paid the average annual fees of 3.1% and assumed your fund manager was even able to achieve the same returns as the market, your account would have dropped by 40%, leaving you with only $60,000. To better disguise fees, mutual funds and most 401k plan providers came up with quite different and confusing terminology. No matter what they are called, they all cost money. Here is an overview from the Forbes article on the average costs for investors. Before we get into how to escape this maze, I'd like to entertain you with a brief look at the returns mutual funds advertise. The financial wizards on Wall Street have come up with a peculiar way of calculating their returns. How they do it? Well, when a mutual fund promotes a certain return, it's not the actual return that you as an investor receive. This is because the returns displayed in marketing materials are known as time-weighted returns. The mutual fund manager claims that if we start with $100 at the beginning of the year and end up with $120 at the end of the year, our return is 20%. This is the point when the marketing department starts advertising. In reality, though, most investors don't have all their cash invested at the very beginning of the year. They usually make contributions from their paychecks throughout the year. If they invest more during times when the fund is doing well and less during times when it isn't, their actual return will be far from the advertised return. The real-world approach to calculate investment returns by taking into account ongoing contributions and withdrawals is called the dollar-weighted return, and it differs from the time-weighted returns used by fund managers for advertising purposes. We've compared returns earned by mutual fund investors, dollar-weighted returns, with the returns earned by the fund themselves, or time-weighted returns, and the investors seem to lag the fund themselves by 3% per year. Heck, when a mutual fund advertises a 6% return, the actual return investors receive is more like 3%, and that's all before fees. Before we see how to deal with this, let that sink in. The mutual funds offered to me are imposing huge fees, which could potentially deplete 70% of my profit. Historically, 96% of actively managed mutual funds have failed to perform as well as the market or their benchmarks. In comparison, owning a low-cost index fund and tracking the market would cost me only 10 to 30 times less. Mutual funds advertise with time-weighted returns, which are typically higher than the dollar-weighted returns that investors actually receive. Fred Schwed Jr., a former Wall Street trader, wrote the popular investment book called Where Are the Customers' Yachts? Or A Good Hard Look at Wall Street. The ironic title of the book has been retold in several ways over the years. The successful broker William Travers admires all the beautiful yachts in Newport, Rhode Island. By chance, any yacht he is looking at is owned by a broker, banker, or trader. Where are the customers' yachts? Asked the naive visitor. 80 years after the story was first told, it is still as relevant as it was then. A Morningstar study covering more than 4,300 actively managed mutual funds found that 49% of managers do not invest in their funds themselves. The chef doesn't eat his own cooking. Of the remaining 51%, most have only made small investments in their funds compared to their remuneration and net worth. Since the fund managers themselves invest almost nothing in the funds they manage, a logical question arises. Why should I invest in these funds? What you want to do to improve your return on investment and actually make money is to escape the fee factories and marketing brochures. To minimize fees, aim for a total annual cost of 1.25% or less, which includes the cost of advice from a registered investment advisor and the investment fees. For instance, a 1% fee for an advisor and 0.20% for index funds could result in a total cost of 1.2%, which may be tax deductible. This can help you achieve your financial goals faster and potentially retire earlier if you so choose. If you don't want to pick stocks yourself or mimic the market by investing in an index fund, but want conflict-free advice, you should seek out a fiduciary. These professionals are required by law to eliminate potential conflicts of interest or disclose them and put the client's needs above their own. And if you're wondering which video to watch next, have a look at this video on screen I handpicked for you. Anyway, thanks for watching and subscribe.